all sorts of tea about what's going on inside Washington, D.C., what regulators and lawmakers are thinking about and working on, and what you and your credit union should be focused on in terms of risk areas and areas of opportunity. I'm your host, Ann Petros, also Vice President of Regulatory Affairs at NAFCU, and today I am joined by Tony Hutchinson, Senior Vice President of Industry and Government Relations at VantageScore. And Tony has spent much of his career at the GSEs, Fannie Mae and Freddie Mac, and is an expert on housing finance policy. Thank you, Tony, for joining me.
Oh, thank you for having me. Great to be here.
Yeah, absolutely. So today we'll be discussing a really important topic and very timely issue, the FHFA's recent steps to transition away from the classic FICO score and incorporate two newer credit scores into the housing finance market.
Very exciting stuff.
Definitely very exciting. Yeah, things are changing. So the FHFA has been working on this initiative for quite some time now. Can you walk me through the history, including the legislation that sort of kickstarted this whole initiative, and then the FHFA's rulemaking and the whole model validation process? It's been a process.
It's been a while. So back in 2016, there was a rule proposed, and it came as a portion of larger legislation, but it focused on modernizing, for the most part, and bringing competition to, really, the mortgage market in terms of credit scoring. The legislators thought that the existing score had a bit of a monopoly, and they wanted to add more competition in the marketplace. And that, like I said, that was 2016. It was signed into law in 2017 by former President Donald Trump. And from that point, FHFA has been working to implement the new rule. So what the law indicated was that FHFA needed to explore whether or not other credit scores could be used in the mortgage market. And if they found that they could, then they had to then bring them into the space. Well, that process of evaluation took about 5 years for the most part. They gathered information. There were requests for information from numerous credit scoring companies who submitted information, data, their methodologies to FHFA for review. And FHFA decided in October of last year that there were two scores that they thought, I don't want to say they thought, that they authorized for use in the mortgage space. And those two scores were VantageScore 4.0 and FICO 10T. Part of the reason that they decided to do that was they wanted to, one, try to include more people in the mortgage market. There have been issues for years about folks being excluded from the marketplace. So these two scores, and I'll talk about this a little bit later, are more inclusive. In particular, I'll talk about VantageScore and how while we are more inclusive. The other thing is, coming out of the financial crisis in 2008 through 2010, they wanted to find mechanisms to help the GSEs operate more safe and sound. And the new scores, because they're more predictive, and I'll talk about that in a little bit later, will help the GSEs fulfill that mandate. So October of last year, they indicate that they found two scores they're going to authorize. They initiated that. And then just this past March, they've put in place a timeline for the implementation to take place. And that's what we're working towards now. What you'll find is a lot of folks, one, either have not heard about this change, which is why I'm glad we're here talking today. And two, if they have heard the change, they don't fully get what's behind it. And why it was done and when things are expected to take place.
Right. But it is coming up, and we definitely need to start thinking about what this is going to mean for
it's absolutely coming up. The thing that's kind of funny about that is the timeline that was just put out on in March of this past year indicates that people will have to pull both a VantageScore 4.0 and a FICO 10T in the third quarter of 2024. That is literally about 14 months away. So people need to start thinking about what contracts do I need to get in place so I can pull these scores?
Mm-hmm.
They also need to think about, do I have the technology in place? Do my providers, my third-party LOS providers, if I'm not getting the scores directly from credit reporting companies, are they going to be able to provide it for me? So they need to begin to have those types of discussions internally and with their external partners to want to figure out, can I get the scores in? And if I can get the scores in, then how do I contract to do that so that on day one, I'll be ready to operate?
Yeah, absolutely. A lot of questions that need answering and things to think through. So one of the changes was moving from the tri-merge credit report to the bi-merge credit report requirement. And we've heard from some credit unions, that they are, I guess, excited about this, much prefer the bi-merge option. But from your perspective, why is this change going to be beneficial to lenders and consumers?
Okay, so FHFA has indicated that part of the reason for introducing competition on the credit score side was because they wanted to help lower pricing for consumers. That's the same motivation for going from a tri-merge to a bi-merge. Mm-hmm. They're hoping to create some competition between the credit reporting companies so that you can have some price advantages for the consumer. There have been a lot of questions about this. Some folks have had a little bit of trepidation from moving from the tri-merge to the bi-merge because there's still rules that need to be promulgated by the GSEs about how the decisioning will occur with just 2 credit reports being pulled that will now encompass 4 scores. But I think a lot of people, because the scores are more stable, in particular, VantageScore is more stable across the bureaus, which means that there's not a lot of variance, then going from 3 to 2 makes a lot of sense. So now there is an opportunity to try to place that advantage, that cost advantage to the consumer. So I think there's a lot of excitement out there about going from 3 to 2. There is some trepidation because some of the folks who've used 3 in the past just need to know what are the rules of the road. And I think as soon as the GSEs, let me remove that, I know that the moment the GSEs, Freddie Mac and Fannie Mae, put the rules in place to tell people how the decisioning will work, and they provide some background on what their rationale is, I think the market will be fine. And just so you know, I've recently heard from the FHFA that it's not a mandate that you now use the bi-merge.
Right.
But that you can use the tri-merge, mm-hmm. You have the option. So you can still use the 3 if you're comfortable with that. Mm-hmm. But if you are looking to maybe have some competition and to reduce some costs for your consumers, you can go to the bi-merge. And I think, what you were indicating is your members, they're looking for ways to increase savings for their members. Mm-hmm. And this would definitely be one of those ways.
Yeah, definitely. And I think, some of the other comments that we've heard from members is just consumer confusion. Like, why do I need, the 3 credit scores and how it's calculated, like the average versus, the middle score. Yes. So, I think there are potentially some benefits there as well.
And I believe that FHFA thinks so as well. And again, let me remove I believe. I know that's what they've stated. Their whole purpose for this, outside of just bringing competition for the sake of bringing competition, because that's not really any motivation. They brought the competition because they want to foster savings for the consumer. At the end of the day, there are 2 things that FHFA is really trying to promote here: savings for the consumer, mm-hmm. and safety and soundness in operations for the GSEs, because nobody wants to go back to the issues that we had from 2008 to 2010.
Right. Certainly want to avoid that.
Yeah, we definitely want to avoid that.
Well, okay. So now that VantageScore has an approved model that can be used for mortgages sold to the GSEs, what do you think will be the biggest benefit to lenders and consumers?
So VantageScore 4.0 brings a number of advantages to the marketplace. The biggest one being we score 30 million more Americans than the traditional score.
Wow.
30 million more consumers. That is folks that have thin files, mm-hmm. folks who are new to credit, and folks who have had credit but have decided to pull it back, personal reasons. As we get older, we tend to use less credit, but they begin to then disappear from the credit rolls. And what you find, and this has happened to my mother, she has stopped utilizing credit. Then all of a sudden she gets a notification from one of her cards saying, we're going to take back your card, or we're going to reduce uh, your limit because you aren't using it because of the inactivity there. But that doesn't mean that those consumers
Are
don't
not
need
credit
that. Yeah,
worthy.
that doesn't mean
Yeah.
they're not credit worthy, nor does it mean that they won't need credit in the future.
Yeah.
So we are able to, with a number of techniques that we use, to score those folks, and that allows us to score more people. So what we're going to find is with the new score, specifically VantageScore, you're going to open up the world to a larger number of folks, specifically folks at this point who have been excluded from the marketplace. And that plays right to our mission of financial inclusivity. So aside from those people who've fallen off the rolls, a lot of folks that we're also scoring are what many have considered underserved. So we've got a lot of minority consumers that people have been
Right.
trying to reach out to, a lot of new immigrants to the country are also part of that. And part of the reason we're able to do that is because our score takes into account more information. I know there's a big conversation out there about adding additional information to evaluate people. Well, we've been doing that since our inception. So if there is rental payment in your credit reporting, we can calculate a score based on that. If your telecom information and your utility bills are there, we're able to bring that into the score. What you find is a lot of the folks who have been excluded to this point, they may not have the auto loan, they don't have the home loan, they aren't getting the major credit cards out there. So there's really no way to evaluate them, but they do have an apartment and they are paying their rent. You know, they do have a cell phone and they're paying that. And they've got utilities and those are being paid. So why not include those payments, which are extremely predictive in determining whether someone is creditworthy, and include those. So we've been including those in the score, and that allows us, along with this one other piece that is extremely important, and I stepped over it and I shouldn't have. We now we use trended data to evaluate an individual, and that also gives us an opportunity to figure out, you know, how are consumers using their credit over time. So the way you're evaluated now is we take a look at you point in time.
Okay.
So point in time tells me that Anne pays her debt on time, and you know, according to everyone that you have credit out with today, you're on time. Trended data, we're able to take a look at a 24-month past period.
Okay, that was going to be my question.
Yes,
what is the
24
time
months
period?
is 2 years of past activity, and now we're able to see not just how you're doing in terms of paying your credit, but have some things happen in the past. How have you recovered? Were you doing great in the past, but now things have changed? And we're able to take all of that into consideration so that we can come up with a score for you. Again, it allows us to be really more predictive about whether or not you're going to be able to repay your debts, and what have you shown in the past to be able to do. And we're hoping that, and we're doing that so that we can, over the next 24 months, be able to predict your payment activity. So that's what we've got. That's what we've got going on. And you know, a lot of people have adopted it. A lot of folks outside of mortgages have adopted it. We just released our market adoption report that showed that we have grown by 30% VantageScore for alone, 30% over the last year in terms of usage. We're used by 9 out of the top 10 banks and about 3,000 other financial institutions, including financial technology companies, utilize our score. Last year, we did 19 billion credit score transactions out in the marketplace. So we are growing like gangbusters. We're out there. The only market that we're not in is mortgages. So we have been bringing financial inclusivity to the auto industry, personal loan, the credit card space, utilizing us for student loans. The thing that we need to get into is mortgages, so that a lot of these places and folks who say that they haven't been able to get into or have an opportunity to purchase a home because they didn't have the credit. Now you do. And beginning the third quarter of 2024, They'll be able to go to their credit union and now say, hey, can you evaluate me to determine if I can get a mortgage now? And if I can't, then can you place me on the road to having that opportunity? I think that's really the big power of the new score in this marketplace. These folks who have, to this point, been excluded, and a lot of them have been excluded maybe because they didn't feel that they had a score that was worthy enough, and they never decided to check because they know their personal situation, or they just have tried in the past and were told they had no score.
Yeah.
Now you have the opportunity to come back and determine, where am I on this path? Do I have a good score? If I do, great, let me move down the path. If I don't have a great score, okay, let me figure it out. Now I know what my score is. Now I can actively go out and work to improve it so that I can go down the road of home ownership if I so choose.
Yeah. Well, it sounds like, VantageScore's mission, or at least part of it, is to foster this inclusivity and more equitable access to credit. And, especially something like rental payments, which, can be just as much or more than a mortgage payment. It seems like really should be included.
Right. It should be. Many people already think that their rental payments are utilized to determine if they are worthy of getting a mortgage, but they're not. Because that information, a lot of it is not in the credit reporting, the credit report that is generated by the credit reporting companies. What we've found over the last few years is that more and more rental companies are beginning to report. And I know that the GSEs are also trying to foster that, because like you said, if you can afford a rental payment in a lot of these markets, then you can definitely afford a mortgage. So the fact that you may only have 1 or 2 trade lines, one of them being rent, but you didn't have the requisite 3 that the traditional score required, that shouldn't preclude you from being able to get a mortgage or get into a house if you are making your payments on time. So the new scores, specifically VantageScore 4.0, is going to allow all those creditworthy borrowers out there to now have that opportunity. And I will say this, just because we score more people doesn't mean all those people are creditworthy.
Sure.
Right, it just means that those folks have a score, which is great. But again, that is a good thing, because now even if their score isn't good, they can start working on it. They can
get on the road to improving their credit and monitoring it, being aware of where they stand, and working toward, getting to a better place and a stronger financial footing. But imagine, especially for younger Americans who don't have a long credit history, that this can be particularly challenging. Maybe they've been saddled with student loan debt, right, and haven't been able to make big purchases like getting a mortgage or even buying a car. So it can be challenging to get to that point.
That's right. But if they're paying their student loan back and they're paying their rent on time, and usually that includes having to pay utilities, and I'm sure they've got a cell phone,
right?
So those things should be utilized in order to determine whether or not they're good for the debt that they've taken out. We're looking to, we want to make sure all of that information is included. We're looking for more information too. That's the thing. The more information that we can get on consumers, the better. Now, of course, we want to do that in a fair and equitable way, and we want to do it in a way that protects people's privacy. But the more data that we can introduce into our algorithm, the better it is for the consumer, and the better it will be for the businesses, in particular, financial institutions, because then we'll be able to be even more predictive than what we are now. And at the end of the day, like you said, no one wants to have a repeat of the financial crisis. And one of the things that we learned coming out of that is, the more information we have, the better we understand the debt that's out there.
More data is better.
The better performance can be predicted, and then we can make some decisions about how to either price things or whether or not to invest in them or not.
Now, one of the things that you mentioned earlier was the requirement to deliver both credit scores. Correct. So we've heard from some, credit unions, just concerns that there's going to be an increased cost in delivering these 2 credit scores to the GSEs. Can you describe some of the pros and cons of this approach and why you think the FHFA took this route versus other options like, let's say, lender choice, which I think is what we supported?
So, one of the things I'll say is that everyone, including VantageScore, was surprised that both scores were mandated for use in the new environment. FHFA has indicated that they want to use both to ensure that they're capturing as broad a population as they can, and to, again, we were just talking about having as much data as possible to ensure that they have as much data as possible to be able to predict performance. Admittedly, there are going to be differences between the models. So one of the assumptions that I'm making, and they've alluded to this over at FHFA, is they wanted to ensure that whatever the gaps were captured. Meaning that if there was if we had more information than the new FICO product, then it was captured. It wasn't omitted somehow, and vice versa. So that's why they wanted the 2 to be used together. They've received a number of questions about cost. And to this point, they've not really offered an answer because I don't believe that they know what the cost changes will be. And honestly, I can't tell you because our company, and to disclose, we're owned by the 3 credit reporting companies. So they set our cost and we have no vision into that. There's a bit of a firewall. So we don't know if they're charging the same thing across the credit reporting companies or if they're different. And we don't know how that relates to what is being charged by FICO.
Right.
So there's no way for us to get at that cost. But FHFA has indicated that the whole rationale behind all of this was cost savings. So yes, you are going to have new scores. But if there is a price difference in the scores, the market's going to indicate that either the scores need to be, the cost for them needs to be relatively close, which could cause a reduction. And by going from the tri-merge to the bi-merge, which the credit unions,
there's some savings there,
have indicated is of value to them, then there will be savings there. The key is we don't know how much. No one has done a study on that. No one has offered information on that just yet. I think we'll begin to see that when you start pulling the 2 scores in the third quarter of 2024. And I know that's a far away and it's kind of hard. It's hard. But the other thing that I will say is people are talking about it now. And I would encourage all of your members to share their concerns about that through you and individually with FHFA and the GSEs and potentially the credit reporting companies and see if they can provide some information. Now, that would be one of the easiest things to do if your members already have a relationship with Equifax, Experian, TransUnion directly. Then they can go to them and say, hey, I'd like to pull VantageScore 4.0 right now for a sample set of loans I have. And may I pull the other FICO score? And then you would be able to see the cost, right? Or they'll tell you what the cost is. And then you can evaluate from there. And if the cost differential is such that you find that it's not going to be the savings to your members that you want, then I would share that one with the credit reporting companies. But I would also share that with FHFA and the GSEs because you've got time now before that implementation is mandated to begin to kind of work that out. So that's why, one of the mantras I have is everyone needs to start now, right? Even if you're going to pull just a little bit of data to see how that fits into your systems, if you want to see what it looks like versus the traditional score, your classic FICO, they're going to have you do that anyway, third quarter of 2024, but it'd be really good right now to figure out what that cost looks like so you can begin to budget for that and plan for that and make some decisions around how you want to address that with the regulator and the GSEs.
Yeah, that's a really good recommendation. I know that some of our credit unions do already use Vantage for auto loans or other products. And so they might be able to, figure out what, at least ballpark figure what it might cost. But for those who don't, maybe start thinking about what, loan products you might want to pull VantageScore in to get closer to
exactly
estimating.
And I would say in VantageScore 4.0, I know a lot of credit unions use 3.0. And I would recommend that they migrate to 4.0 for all their products because it's a newer model, so it'll be more predictive. But since 4.0 is what is mandated in the mortgage space, the sooner you become familiar with it, the better for you. And again, if you want to do that price discovery, what better way to do that than to pull it on an existing set of loans that you have and just begin to compare.
Exactly. One follow-up question on the 2 score requirement. It does, as you were talking, it does kind of make sense to me that, maybe there's a little bit of catch up that needs to happen for VantageScore. And so requiring that both be delivered actually is kind of beneficial to ensure that there's as much data and information about both scores and how they operate in the market as possible. Do you think that at some point down the line, maybe we'll see a transition to something like lender choice?
It's hard to speculate. It just depends on what the regulators and the GSEs are become comfortable with and let's not forget investors become comfortable with.
That is the other piece of the puzzle.
As things progress. We were the first to use trended data, so we've been using trended data a lot longer than FICO has. So a lot of the catch up is going to be on their side in terms of putting this trended information out there and information to support it. Though that I'm sure that they're doing gangbusters getting out there and getting and talking to folks in the marketplace. We're trying to do the same thing. I think where we need to catch up is letting people know who we are. A lot of folks have, to this point, like you said, used us in credit cards, personal loans, auto loans. So we're very familiar for folks who have utilized us in those space. But a lot of people who operate in the mortgage space tend to only operate in the mortgage space, or they're divisions of organizations that only focus on the mortgage space. And those folks to this point have had no real reason to get to know us. So the catch up for us is getting out there and introducing ourselves, sharing with people the work that's gone into the development of our models so that they recognize the value that's there. They understand our push for financial inclusivity. We've got a goal that we want to score everyone who is using some sort of payments out there. We want to be able to offer them a score so that they can take advantage of the prosperity that the financial system of the United States provides. And the more information we have and the larger our ability to score people, the more opportunity it is for those folks to participate. So yeah, I think the catch up for us is getting people familiar. And you're going to see us at a lot of different places. We've begun outreach throughout Washington, obviously, in all of the trade associations, but we are going out to all of the financial organizations that are out there, all the financial companies that are out there. Again, do you have a mortgage shop that isn't using us? Let us talk to you.
Right.
Are you a mortgage company? Do you know this mandate is coming to fruition and that you're going to have to start pulling VantageScore 4.0 in the third quarter of 2024? If you don't know us, get to know us. Let us come into your shop and tell you our story. But more importantly, let us talk to your loan officers. Let us talk to your sales team. Let us talk to your risk modelers about the model so that they have extreme familiarity with it. And when their customers come to them, they're able to easily talk about the benefits of VantageScore.
So we've talked a lot about the importance of data and more, mortgage lenders are a bit concerned, I'd say, that there's a lack of historical data available to compare the new scores, right? VantageScore 4.0 and your FICO 10T, relative to classic FICO, right, which has been used for a long time in the mortgage space. So can you offer some reassurance here, especially, that on the timeline that the FHFA has to release that data? What do you think is the best way to resolve this
So
concern?
the first thing, FHFA and the GSEs need to release the data set that they used to make the determination to authorize the new scores. And that has historical information. A lot of folks have been clamoring for that. I know that the timeline indicates that will be released in the first quarter of 2025. I would hope that they would be able to release that sooner.
That seems a little late, right? After you already are requiring the two scores to be delivered.
A lot of people are saying the exact same thing. And could you give it to us beforehand? And the key is, I think, with the pulling of the data along with the traditional score in the third quarter of 2024, everyone will now have an opportunity to see what that performance looks like in real time, and they'll be able to do any correlations between the old score and the new scores, and even between the two new scores to see how things kind of play out. So that'll be real time information they have. But you're right. Specifically for risk modelers, specifically for investors, folks that are holding loans in their portfolios, it would be great for them to see this historic data. And we're hopeful that FHFA and the GSEs will be able to push that out a little sooner than the first quarter of 2025, because people are going to need a little bit of time to digest that. And again, the mandate to go fully to these two scores, dropping the traditional score, classic FICO, is the fourth quarter of 2025. So giving people the data at the beginning of the year and then expecting them to be able to utilize it fully and have these scores going at the end of the year, that might be a bit of a time crunch. So the sooner you can give people data, the better. But the other thing I'll tell folks is, if you have a historical data set now that you want to begin to evaluate the new scores on, you can go to your third-party credit score provider or the credit reporting companies and get data as far back as they are able to provide trended information and begin your analysis now. That would be one way to kind of circumvent waiting for these data sets to be, or this historical data set to be released by FHFA and the GSEs. There's nothing that precludes you from doing that work now. It may cost, but I'm sure that the credit reporting companies will figure out a way to help you with that analysis and get that data so that it's not going to be too costly.
Yeah.
But so I think that there are steps people can take right now. It's up to them to do that. But yes, definitely, the sooner the data can be released by FHFA and the GSEs, the better.
Are there any other issues or considerations you think the FHFA should think about or perhaps reevaluate with their implementation timeline?
I think it's pretty straightforward. A lot of folks believe that this is going to be a hard implementation. I don't believe that. VantageScore doesn't believe that. The key to making sure this implementation is smooth is putting the rules out about how the decisions will be made utilizing the two scores, along with how the GSEs are going to price, because it's all about the pricing decisions and the decision tree that's put in place about whether or not a loan will be purchased by the GSE or not.
Of course.
Once those are put in place, the credit reporting companies can already deliver both scores. The third-party deliverers already have access to that. They may need to sign contracts that allow them to begin to deliver them, but that shouldn't take too long. Most people right now, this is why I'm asking credit unions and other lenders to begin this. If your systems can't handle more than one score per report for a consumer, you may want to begin to work on that, as well as how you would store it,
I think that's definitely a challenge for some lenders, smaller lenders.
Some smaller lenders,
Mm-hmm.
absolutely. But you've got 14 months to get that done. I would begin to work on that now as opposed to waiting until they want you to begin to pull those. But other than that, once the rules are put in place, it should be relatively simple to press the day one button. Yeah, there will be some technology pieces that need to be worked out, but those don't seem to be too daunting. I think the biggest part of the technology piece is we just need to figure out where all those touch points are. So you as an institution will need to know where are all your credit score touch points, and can all those credit score touch points handle 2 scores over multiple reports? And then can you deliver on those? But you got 14 months to get that done for the most part. Once you get that done, it's just a matter of executing the rules that are out there. And that shouldn't take too long.
Yeah. What about other government-backed housing agencies? You got, your FHA, VA, and Ginnie Mae issuers, right? I mean, should those agencies implement similar changes in their credit score requirements to align with the GSEs?
So FHFA and those entities are in conversations right now. I will say that on the government side, there is no mandate for any one type of credit score to be utilized. So you actually have choice over there. If you want to use VantageScore, you can, and you can deliver that to VA, FHA, and Ginnie should be able to securitize that now. They've not done that in the past, but they have the ability to do it because in their rules, there's only the need for a generic credit score. It does not indicate one or the other. Whether or not they're going to follow suit depends, again, on how the marketplace tells them to operate. Right now, folks are saying we don't want a bifurcated market. So I would argue that Ginnie and the folks that sell into them, FHA, VA, even your rural loans, are going to follow suit. The other reason that I believe that that's going to be a no-brainer for them is a lot of the underwriting that that the people who sell into those programs use are from the GSEs. And they'll already be utilizing desktop underwriter and loan.
Exactly. The systems are going to be structured in that way. Right. So then to do something else,
just that adds a complication that nobody wants, right?
Yeah.
So, and like I said, once the investors on the backside say, you know what, this is great. We've got these, we've got VantageScore 4.0. We've got this trended score from FICO. They're covering a more inclusive population. We now see more safety and soundness. Once they say, we understand it, and we're going to buy it, then all no holds barred. It just it'll happen.
All right. Well, it sounds like a couple things to be worked out and evaluated by market players before we can get to some clarity there.
But I would say, start that evaluation now. More importantly, share that information if you run into issues with the regulator and the GSEs. But as importantly, be curious. Be curious about VantageScore 4.0. We're here to be your partner. And I would say to you, I've already offered this to NAFQ. Anytime you want us to come and speak anywhere, even on another podcast about our product, if we can even bring our risk modeler in to talk about the algorithm itself in more detail. That'll be very wonky for some folks, but
yeah, that might be a little over my head too, but definitely interesting.
But we'll make that available. We're extremely transparent. I would encourage your members to go to our website, take a look at it, play around, see what information we have out there, learn as much as you can about VantageScore and VantageScore 4.0. If there are questions that you have that you can't answer on site, feel free to email me. I'll leave my email address right now. It's really simple. Tony@VantageScore.com. How simple can that be? You don't even have to put my last name into it. Tony@VantageScore.com. And you can send me a note and we'll get you the answer. But again, we're going to be working with NAFQ to do education, potentially seminars for the membership as we go, so that you guys can be as prepared as possible for day one.
Absolutely. That's important. All right. Well, thank you so much, Tony. And thank you to our listeners and viewers for tuning into this really great discussion with Tony Hutchinson from VantageScore. If you enjoy listening or watching the CUPP, please hit that subscribe button, that like button, turn on your notifications to get alerts about new episodes. And please leave us a review. Let us know what you'd like to hear about on a future episode. That does it for today. Thanks so much for tuning in. Until next time.